Welcome to our third lesson in this introductory module. We are going to cover the time value of money in this lesson because it is a very, very important concept that is going to come up throughout every other module and case study in this course. Once again, you can certainly read the quick reference guide here. In this case, I think it's a bit more helpful to at least look at the video because we are going to be performing some calculations in Excel in this video, and I think it's a little bit easier to understand those calculations if you actually watch us doing it. However, as always, if you want to, you can certainly look at the quick reference guide. Under key rule number 2, the time value of money, we outline everything that we explain in this video. Our plan for this lesson will be to cover the time value of money first as the overall concept. Then I'm going to give you a real world story about what happened to me when I lived in South Korea for a period of time and had to find an apartment and how you can use that to understand the time value of money. Then I'm going to explain how you can use some of the rules that we lay out here to analyze or think about any investment. And then in part 4, we'll talk about something called present value and the key takeaways from this exercise. One of the most important concepts in finance and valuation and financial modeling is the time value of money, which states that money today is worth more than money tomorrow. This is because you could invest $100 today and end up with more than $100 tomorrow, or in a week, or in 5 years from now. For example, you could put $100 into a savings account that gives you a 1% interest rate, and in a year, you will have $101 in the account rather than $100. Now, this is not because of inflation, although that may also contribute. The real reason for the time value of money is that you could invest money today and earn more with it tomorrow. So if you have $100 today and $100 in 2 years, the $100 today is worth more to you today. Now, a lot of finance textbooks go into this concept, but they don't really give good examples for how to think about it. So I'm going to share a quick story of something that happened to me in real life and show you how you can use this to understand the concept of the time value of money. A long time ago, I lived in South Korea and I had to find an apartment there. Now, the real estate system in South Korea is unique, and there are 2 ways to rent an apartment there for the most part. We're going to call these option 1 and option 2, although I listed the Korean names for them on screen. With option 1, you pay an upfront deposit for a huge portion of the apartment's value, usually 50 to 80%. However, in exchange, you pay no monthly rent and you get the deposit back when you move out. Now, with option number 2, you pay a much smaller deposit, only around 5 to 10% of the apartment's value, but you do pay monthly rent and you still get that deposit back at the end. So we're dealing with one option with a very high deposit and no monthly rent, and then another option with a much smaller deposit and then monthly rent that you have to pay. To give some specific numbers here, let's say that with option number 1, the apartment value is $200,000. The deposit is $150,000, which is 75% of the value. There's no monthly rent, and so you get back that $150,000 deposit after 2 years. If we were to represent this in Excel, you can see I have the file up here on screen. For option number 1 with this large upfront deposit, let's take our deposit right there. We'll enter 0 in year 1, and then we'll say that we move out in year 2, so we get the deposit back at that point. Now, with option number 1, we have no rent on a monthly basis, and therefore no rent on an annual basis. So we'll enter 0 for annual rent. Our net cash flow each year will just be the summation of all these. And so if we look at the money lost here, let's just sum these up. It seems like a great deal because we pay this deposit, we don't pay any rent in between, and then we get back everything at the end. So it appears that we haven't lost any money. Now with option number 2, the apartment value is still $200,000. The deposit is 5% of that, so $10,000. There's monthly rent of $1,000, and we get back that $10,000 deposit after 2 years. If we were to represent this in Excel, it would look like this. So the deposit paid here is much smaller. It would only be the $10,000 rather than the $150,000. In year 2, we get this deposit back. Then for the annual rent, we have nothing in the sign-up period. And then in the first year, we pay this $12,000 of annual rent, which corresponds to $1,000 of monthly rent. And then we do the same thing in year 2. And then we'll sum up the cash flows. And so if we look at the money that we lose here, it appears to be a lot worse because we've lost $24,000 now, whereas in option number 1, we haven't lost anything. Now, most people I spoke with when I lived in the country looked at the scenario and they analyzed it exactly the way that I just showed you. 99% of these people told me to go with option number 1 because I wouldn't lose money. To them, the options look like this. Option number 1, no money lost. Option number 2, you lose $24,000. The punchline is that they were all wrong, or at least they were not completely correct about their reasoning for this decision. So the reason why they were wrong is that $150,000 after 2 years is worth less than $150,000 today. So yes, Excel tells us that we get back this $150,000 after 2 years, but it's not going to be worth as much to us in 2 years' time. We could have taken this money and invested it today and earned something with it and gotten more than $150,000 in 2 years. So actually, if we had just locked up our money like that and done nothing with it, we would have lost money on this. The second reason they were wrong is because they didn't consider the opportunity cost of a deposit that's $140,000 higher. In other words, what could we earn extra with that money? So if we could earn, for example, more than the $24,000 in rent, then perhaps it makes more sense to go with option number 2, you invest that $140,000 and earn extra money with it. On the other hand, if we're not going to be able to earn as much as this $24,000 with this extra money that we get from a lower deposit, then maybe it doesn't make as much sense to do that. To illustrate this concept, let's jump into Excel now and go into some of the numbers behind this. And just like we're expanding our reasoning and thinking a little bit, I'm going to expand these rows in the Excel spreadsheet. And now we're going to look at money lost plus opportunity cost factored in. So first off, we need to look at the lost earnings here, because when we put down this $150,000, we lose something by not being able to invest it elsewhere. Now, to be fair, we have to consider that we also have a deposit in option number 2. It's just a much smaller deposit, $10,000 rather than $150,000. Therefore, if we look at option number 1, the extra amount that we lose over option number 2 is not the $150,000, it's actually $140,000. We have to take our deposit in option number 1 and subtract what it is in option number 2, and that gives us the differential of $140,000 right here. Now, we don't know exactly what we could earn on this, but to keep the numbers relatively simple, I've said that our opportunity cost is 10% here. So we believe that we could earn 10% per year on our money in real estate or the stock market or bonds or some other type of investment with this $140,000. So we'll link to those numbers and multiply. And then for the lost earnings in year 2, we have to factor in both the deposit difference here and then also the amount of earnings that we lost in year 1 as a result of putting down this much higher deposit in the first place. So we have to include both of those to be completely correct here, multiplied by the 10% opportunity cost once again. And so once you factor in the money lost plus the opportunity cost, we get to this figure of $29,000. And suddenly, option number 1 looks a lot worse to us. Now, of course, this is dependent on actually earning 10% per year on this money, which is very difficult to do even when the market is going well, when prices are going up. So we don't know how realistic the scenario is. But if we actually believe that we can earn 10% with our money elsewhere, then clearly option number 1 is worse for us. We should go with option number 2, put down a much lower deposit, pay rent, and then lose money, but actually come out ahead because of the fact that we would not have been able to earn as much with option number 1. So you can use these principles to analyze any investment. The key question is, would you earn more with an investment than you would earn on similar opportunities with similar risk profiles elsewhere? Or would you earn less than you would with those opportunities? For example, if you could invest and earn a 5% yield on something, then something that yields 8% with a similar risk profile is clearly an improvement. But something that yields 3% with a similar risk profile is not an improvement. When you think about these types of scenarios and you project money or you have money or cash flow in the future, you must always discount it to its present value when you're analyzing it. So if you think about this $150,000 deposit and what it's worth to us today, it depends on our opportunity cost, what we could earn with it elsewhere. For example, we could take this deposit right here, and then we could divide it by 1 plus our opportunity cost, raised to the power of the number of years, which is 2 in this case. So to us today, it's only worth $124,000, because if we were to invest this $124,000 and we get 10% on our money each year, take a look at what happens. By the time we get to year 2, we have $150,000. And this is why when we get this back in year 2, if we really could earn 10% on our money, it is worth a whole lot less to us in terms of its present value. Now, of course, this is heavily dependent on the opportunity cost. At 10%, yes, it's worth significantly less. But if your opportunity cost is only 1%, then it's worth much closer to its original value, $147,000 versus $150,000. So the present value of money depends heavily on what our opportunity cost is. Going back to the situation with housing in South Korea, the correct decision here really depends on how much I could have earned with that extra $140,000. You could try to figure this out, and you could enter various numbers to guess your way into the correct answer in Excel if you want to. But one shortcut to doing this is to use the goal seek function in Excel. So if I go to Alt-A-W-G, and I want to set cell H36 to value -24, and I want us to change cell E21, the opportunity cost to do it, Excel will solve for this and tell us the point at which the -29,000 here equals the -24,000 here by changing this opportunity cost. And the answer is 8.2%. So this is the break-even point. And what it means is that at 8.2% for the opportunity cost, the money lost plus that opportunity cost factors in equals $24,000, the rent for 2 years. So if I believe that I could invest that money elsewhere with a similar risk profile and earn more than 8.2%, then I should go with option number 2, pay $12,000 in rent per year, pay a much lower deposit, and take that extra money and invest it elsewhere. But if there's no realistic chance of earning more than 8.2%, then I should go with option number 1, and I should pay that much higher deposit, save the money on rent, and I will come out ahead that way. Let's do a recap and summary now. So the time value of money is one of the most important concepts in finance, and it states that money today is worth more than money tomorrow because you could invest it today and earn something more with it tomorrow. It also means that whenever you're looking at money in the future, you have to discount it to its present value based on your opportunity cost, what you could earn with that same money today if you invest it today in other opportunities. I told you this quick story about finding an apartment in South Korea and how there are 2 options, one with a much higher deposit but no monthly rent, and then one with a lower deposit but monthly rent, and how on the surface it seems like it's a much better decision if you have the money to pay for that higher deposit and save the money on rent, but how actually if you could earn a certain amount, over 8.2% per year in this case, then it would make more sense with the numbers we looked at to go with the lower deposit, pay monthly rent, take that money and earn more with it elsewhere. To analyze any investment, you can use these concepts, and you can think about what you are earning with your money in one opportunity that's available to you and compare it to what you earn on your money in other opportunities that are similar and that have similar risk profiles. Then we went through the concept of present value and some of the key takeaways and discussed how you always have to discount future money or future cash flow that you receive from an investment or real estate or company or bond or anything else to its present value because of this concept, that it's worth more to us today than it is tomorrow. And we discount it based on our opportunity cost. That's it for this lesson. Coming up next, we'll be defining these terms more formally, and we'll be moving from opportunity cost and apartments in Korea and the time value of money into more formal terminology that you typically use in the finance industry to describe everything here.